Hey everybody, Leia Baraza, moving in Sacramento. So excited to have my very good friend Sarah Lee on here. She's the branch manager at Guild Mortgage. She's a mom of four, grandma of two, active in the community, and very big heart in giving back to nonprofits, specifically giving back to women and children. And just really happy that she's going to be here today talking about all her expertise within the lending industry regarding the California Dream for All program. Sarah, thank you so much for being here today.
Thank you. I am really excited to talk about this program. There's a lot of information out there right now, and I think it's important that people get very clear, concise information. And I hope that it's okay for me to also mention that the state of California has also specifically said anytime they're giving us information that the guidelines won't be released until Monday, March 27th. Everything is subject to change between now and March 27th.
And with that being said, I've been listening and hearing and seeing on social media this California Dream for All program. Everybody's really excited, realtors, lenders, and they just keep pushing this information out. And now what you're telling me here is that there is no real stipulations that have been issued out with the guidelines?
They will not be prepared to release the guidelines until Monday, March 27th, which is also the date that the program becomes available. And even though CalHFA is sharing information directly with us lenders, there is a little asterisk at the bottom of everything that they share with us, which is subject to change. And I think that everybody should take everything that they're hearing with a grain of salt, because the state of California is behind the scenes still trying to finalize how this is all going to work.
So what is that doing for the consumer, the buyer, the home buyer that's being told by their realtors out there, that's being told by their lender that there's this amazing program that's coming out, and what happens if on March 27th it isn't everything that they were saying before? What's going to happen to those home buyers that got excited and maybe aren't really qualified to get this loan? What do you foresee may happen?
Well, what I would say is that there shouldn't be any lender out there who is issuing a pre-approval or even a pre-qualification, assuming that their consumer is going to be able to use this program. That would be irresponsible. I think that lenders should tell their customers this program is coming on the market. And when it arrives on the market and we have all of the details, then we can evaluate your scenario and determine whether or not you would qualify to use the program. People who are already walking around feeling like come the 27th, they have this 20% down, they might unfortunately be really disappointed if there is some aspect of FICO score requirement, or, maybe, not to get too into the weeds about it, but it's going to be what they're telling us is it will be a conventional only program. So that means people who can only qualify for an FHA loan or a VA loan, they're not going to be eligible. And just because they meet the minimum credit score requirement, so let's say they have a 680 credit score, and this is what the state is telling us right now will be the minimum requirement if you're not below 80% of the median household income. Just because you have a 680 credit score doesn't mean you're going to qualify for a conventional loan, because you still have to obtain what's called an automated underwriting approval. We call it AUS. With Fannie Mae, it's called DU, desktop underwriting. There have been times, Leah, where I've had a customer with a 702 credit score, and because they're using this layered risk program, right? The borrower isn't really coming in with any of their own money. Fannie Mae recognizes that as higher risk, and you don't get the approval. So I'm kind of going into the weeds about this because I want to show an example of how on paper you might think that you qualify for this, but you still won't qualify because the automated system has to view your risk as low enough to get an approval.
See, that makes me feel a little bit better, because my fear that I came from in understanding the CalHFA loan was, before it was, I don't know, it was $1 billion that they were saying they were going to give out, and now Gavin Newsom has now lessened it to $300 million. And what was the reason that he did that?
He did. So originally they wanted $1 billion over 10 years. Then they We're hoping to roll out 500 million over this first year, and Gavin Newsom, our governor, pulled that back to 300 million. And essentially, it's all surrounded concerns about falling equity in our state, which means, in layman's terms, home prices dropping. So if you buy a house today at $500,000 and it's not worth $500,000 when you go to sell it 5 years from now, you will be upside down. And that creates another whole host of potential issues if you find yourself in a situation where you have to sell the house.
And I think that's the whole thing of where I was coming from. I didn't want to just focus on parts that scared me, which were that this smelled very much like 2005 subprime mortgages, when CalHFA was very much involved back then in several different programs, especially the adjustable rate mortgages, things that were, it was all messy then. And I just came from a space of where, I purchased a property in 2005, and then it was an adjustable rate, had a CalHFA program attached to it, lost our home. I was a young 25-year-old girl, wanted to, do what was right. And then in 2008, we all know what happened. And so what occurred to many of my clients, they thought that they could get a short sale. And many of these second loans that were attached, these homes that were not getting approved for these short sales, now we're going into foreclosure and going back to the bank. So I have a lot of trauma that occurred back then, and I have a lot of, I'm very cautious when it comes to things like this, especially when there's a lot of hype involved. What I've noticed is that there are realtors out there who do not do their homework and who are very anxious and very excited, and maybe are newer to the industry, or maybe don't really have that kind of ethics that you and I share. And I just wanted to make it very clear, because I felt like there was just a lot of hype. And when there's hype, that's when trouble happens. And if I would have waited, I think in the time when I decided to purchase when I was younger, I could have waited a few more years, and 2010 would have gotten triple the size of a house for the same exact price. What do you see that's positive about this loan?
I want to go back just a moment and talk about the differences between the market in 2005, 2006, 2007, right, and the market that we have today. We do see falling equity in the state, but it's not this dramatic drop, right? Like in the early 2000s, it fell off a cliff. And it's very complicated what happened back then, but one of the main reasons that we're different now is our inventory, the number of houses that we have for sale. So back in the early 2000s, we had a glut of inventory. We had so many houses on the market. And, for anybody who's completed a high school economics course, it's supply and demand, right? So if there's little supply, there's more demand for that. Housing is a core need. People will they need to have a roof over their head. They will give up vacations before they can give up their housing. They will give up the brand new car before they can give up housing. So while I would not be surprised to see some drop in value, I don't anticipate at all that we're going to fall off of a cliff.
Unless something catastrophic might happen, war, pandemic,
or another banking crisis, which now we're seeing every day. It seems like another new bank in the markets, which, don't get me started on that, but in 2018, the government decided that it would roll back stress tests on regional banks. And they just thought it wasn't necessary, whatever. And then we saw what happened, right? We're seeing these regional banks that didn't have to go through the same stress tests. The crash of the early 2000s taught us that we needed regulation. And when we roll back regulation, sometimes bad things happen. So we are starting to see some cracks in the banking system right now within those regional banks. And if it's not a crack that the government can shore up very quickly, then you're right. There could be potentially another catastrophic event. I don't think so. I think because there are funds there that were put aside, after that crash of the early 2000s, I think that we're going to be okay with banking. But You and I don't know what's all, we don't know what's all going on behind the curtain.
Right. And all we can do is just continue to know what our history is, where we've come from, what we've been through, and then assess actively and not just be passive when making choices and decisions on behalf of our clients, because they really, really depend on our decision. They ask us, what do you think? What do you think? What do you think? And we do have that power to be able to steer them into a direction that for some may not be the best decision. And so that's why I thought it would be really important that we just get on here and talk about, all the things that are going on, some of the things that I see that may be historically repeating itself. But the other thing is, there's lots of pros, and I can understand the excitement of what's going on. When he changed this amount to 300 million, how many home buyers can really purchase then with that number?
About 2,300. I mean, it's not a huge number. They expect the funds to last between 6 and 12 months. And look, it's 2,300 more people than had a house before. And kind of diving into your earlier question about what are the pros of this. As long as the customer understands the program, there are a ton of pros here potentially, right? If the market cooperates and the customer understands the program. So if, before March 27th, if you were going to CaliGFA to get a loan, you could get a loan for the minimum down payment. On a conventional loan, that's 3%. On a FHA loan, that's 3.5%, right? So they give you the mortgage for your first mortgage, and then that portion that was supposed to be your down payment, right? They give you a mortgage for that. So in that scenario, you were exposed to 100% financing as well, right?
Mm-hmm.
But because you didn't have a 20% down payment, you were paying mortgage insurance. Mortgage insurance doesn't help you qualify for more house, right? That's actually eats into how much qualification you have. And so having a 20% down payment will mean that these people can qualify for more house. They won't have private mortgage insurance in most cases. Private mortgage insurance it's an insurance policy that protects your lender. It doesn't do anything for the customer other than allow them to purchase before they've saved 20% down. So that mortgage insurance, you're paying it each month on your monthly payment, and it's not going towards your principal. It's not going towards your interest. It's really just going to protect your bank in the event that you might default on your mortgage. So when you get into a position where you don't have to pay private mortgage insurance, that's great. That's more money in your pocket, or it's more money that can go towards qualifying for more house. Mm-hmm. So there are going to be people who were previously pre-approved at significantly lower amounts now, because they can buy, like, maybe instead of a $300,000 range, might be able to buy closer to a $400,000 range. That puts them into a different neighborhood. That gives them choices.
If they weren't qualified before this program and they pushed that limit to purchase more, like one of the people in maybe the relationship loses a job and they went way beyond their means, do you see any issues? Do you understand where my problems are with that?
I do understand. And actually, I think this is a good time to point out that CaliGFA has more restrictive debt to income ratio maximums than if you weren't using down payment assistance. So if you were just using if you just used a standard mortgage, typically, in many cases, we can push that debt ratio up to 50% on a conventional loan. With CaliGFA, they want to see us no greater than 45% debt to income ratio. Not 5%. It's not going to completely offset somebody losing their job, right? But I do want to point out that CaliGFA is more restrictive when it comes to the debt ratio, because they do understand the layers of risk.
If somebody decides to get qualified, they get the 20% to help with the down payment, the closing cost, the assistance. Decide to sell the property, they have to give back that 20%. What happens if there's a depreciation in the value of homes?
So CaliGFA has confirmed to us, and again, asterisk, subject to change, but they've confirmed to us that, a 20% shared appreciation of $0 of appreciation is still $0, right? So there will be they're not going to say, well, we expected a minimum appreciation of X amount of dollars. If there's no appreciation, if the home is worth, if you bought it for 500,000 and 7 years later it's worth 500,000, there's no appreciation. All you owe back is the principal balance.
Except subject to change.
Except subject to change. I can't imagine that they would change that aspect of it, because that would make the state of California very predatory, and I don't think that that's their plan at all.
All right. Well, I hope not, right? You want to always think positive, but like I said, when you've been through trauma and you've seen and you felt from personal experience, you do tend to become a little bit more cautious when it comes to these type of programs.
We don't know, Leah, is we don't know if they will share in depreciation. That detail is not floating around out there. I think it would be amazing if they did. If they said, we're going to partner with you in this, and if the home is dropped in value by 20%, we share in that depreciation with you. That would, that would be amazing. I do think, though, for anybody who has not heard about the program, that we should do a quick little recap of what it is that we know right now, which is that if you meet the income limits for CalHFA and they target moderate to low income borrowers, that this program would be available, and it's 20% for your down payment or closing costs. You can use it for either. And I will say that in Sacramento County, that limit is $202,000 a year that you can earn and be considered a low to moderate income borrower. It varies by county. If you borrow the 20% down for the purchase, that will be a junior lien reported on the title to your home. So you'll have your first mortgage, and you will have to use CalHFA's conventional first mortgage program. They're going to come up with a special one that will be paired with this 20% junior lien. There'll be no monthly payment due on that. The 20% that you borrow for your down payment will be due in full once you sell the house or transfer title, of the property, or come to the end of your 30-year term. So, theoretically, you could keep the house for 30 years, and I'll talk in a minute about what would happen, or what we know right now would happen if that were to occur. When you do sell the house, whatever portion of appreciation there is, you have an agreement with the state of California about how much they'll get. So let's just use the scenario of $500,000. If you were in a bracket that your appreciation share was 20%, and you bought the house for $500,000, you sold it for $640,000, that's $140,000 of appreciation. You would be able to keep $112,000 of that, and they would keep 40. Hang on a second, I should have done this.
You only keep that, though, if you decide to sell on your own.
Exactly.
You will have fees if you're working with a realtor, which we highly advise that you work with a realtor.
Thank you for bringing that up. Yeah. So the state of California would keep $28,000. You would keep $112,000, and then from that minus, whatever your closing costs are as a seller. But that would be a scenario in which there was appreciation. We're being told if there's no appreciation, you would just owe the state that junior lien that was tied to the property of $100,000. What we were just talking about was, wouldn't it be great if the state also participated in depreciation? We don't know that they're going to do that. I think it would be great if they did. Let's say you kept the house for 30 years. They would have, and again, this is what we're being told now, they would perform an appraisal to determine the value of the house at the end of 30 years. And at that time, you would owe the 20% down payment plus the portion of appreciation that they're due. So if for 30 years you've just been sitting in your house enjoying your lovely home, and the 30-year clock is up, I hope that you've been saving.
So what's the average of people that sell and buy a home? The movement time, it's about, I've read it's 7 to 10 years.
It's 7 to 10 years, but did you know that in California, Californians keep their homes at a higher rate than anybody else in the country? Our average is 14 years that we keep a home before we sell it. To do with our tax situation, right? Prop 13, which means that our property taxes don't change if we don't
stay put.
Stay put. So I think that has a lot to do with it as well. But in California, we keep them for, on average, 14 years.
Wow, this has been an amazing Zoom with you, Sarah. I really appreciate all of your insight, all of your feedback, your experience. We just wanted to get together on the Zoom so we can make sure that you guys hear, the pros, the cons, you hear the history, you hear where the future might be going, and just make sure that you are all well informed out there, whether you're a realtor, another lender, or a home buyer, home seller, investor looking to possibly know what's going on in the market.
And just as a final parting note, I just want to say, I think that it has the potential to do amazing things for people who have not been able to break into the housing market. But I want to point out that the average consumer who uses CalHFA products are not very sophisticated when it comes to complex financing instruments. And I don't say that as a derogatory comment on this buyer pool, but I'm saying it because I'm talking to the real estate agents and the loan officers out there. Make sure that they understand beyond the shadow of a doubt what the potential pitfalls are when it comes to this product, because it's our responsibility to make sure that they understand that. And this is not your standard make one payment, one fixed payment every month for 30 years and then the house is yours. So we have a deep responsibility to make sure that they understand what they're signing.
And just to kind of piggyback off that a little bit, a lot of the things that came to my mind when I heard about this program and about, you mentioned that there is a class that they have to sit through. All I kept thinking about was the people in 2005 and 6, and thinking about the type of buyers that were out there. Many were, English was their second language, and they were just doing whatever was being told. As a young 23-year-old, we lost our house in 25, but at 23 years old, I was just doing what I thought, whatever the lender told me to do. I didn't know. And unfortunately, what that causes, and this is what I don't want to happen to many home buyers, is what that caused for me was that put us back for many years. And I do not want that to happen to the 23-year-old Leah that's out there right now, who's just, doesn't want to live at her mom's house with her children. She wants to be in her own place and be anxious to jump onto something that may not be the right move right now.
Well, and I tell all of my CalHFA buyers prior to this program, the ones who were just borrowing 3%, right? I told them, even though there's no required monthly payment due, my recommendation is that you chip away at that. Send in payments and chip away at it, right? Because that is what you are doing on a standard 30-year fixed conventional loan that's not this, balloon payment or shared appreciation. So if you do decide to use the program, do everything in your power to chip away at that balance, so that if you do find yourself in a position where you have to sell and it's not in an ideal market, that you've given yourself a little buffer.
That's why I love you, Sarah. Thank you so much. It was a perfect end to just informing our community out there about what's going on with CalHFA. Appreciate you so much. Thank you.
My pleasure.
All right.
You can find me all kinds of places. So Sarah Lee Home Loans is my tag on Instagram, on TikTok. I do a couple of videos a week trying to just keep up this whole education theme, informing people on what's going on. You can find me at guildmortgage.com/Sarah Lee. And it's Sarah with an H, not like the pound cake. So it's SARAH.
And then I, again, am Leia Baraza. Thank you so much. And you can find me on Instagram at leah.momentum, or my phone number is 916-879-4435. We are here for all of your real estate needs. Thank you so much again, Sarah.